If you're new to investing, you've probably heard terms like buy a call, sell a put, short a stock, covered calls. And honestly, it sounds like everybody's speaking a different language, especially when you're first starting off in trading, like I was about 3 to 6 months ago. So in this video, I'm going to explain every major way people make money in the stock market, what these strategies actually mean, and most importantly, who is on the other side of the trade and why would they agree to it at all, right? Welcome everyone to Chrissy's Trading Desk. On today's episode, we're going to get into different ways to make money with stocks, but breaking down what each of them is. Let's start with the simplest one of all, I think we can all agree with, in just buying stocks. It's what most people do. Essentially buy a share in a company that you believe in because you believe it will increase over time. So for example, you buy a stock at 100, it rises to 120, you sell it, you make 20 bucks. Pretty simple. But why did somebody sell it to you to begin with? Maybe they made enough profit. They might just need the liquid cash. They might think the stock is undervalued, or potentially they're moving their money somewhere else. Two intelligent investors can look at the same stock and reach completely different conclusions about them. So let's talk about short selling. Short sellers basically make money when the stocks go down. They borrow shares from a broker, sell them immediately, and then hope to buy them back at a lower price. Let's talk about an example of this. You sell at 100 and buy back at 80, so it's $20 per share. So why does someone buy from them? It's because the buyer believes that the stock will rise. One side is bullish, which means they believe it's going to go up, and one side is bearish, where they believe it's going to go down. Now let's talk about buying call options. A call option gives you the right to buy 100 shares at a fixed price before an expiration date. An example of this, let's say Apple trades at 100. You can buy a $110 call. This means you believe Apple will rise above 110. If Apple reaches 130, your option becomes much more valuable. So why buy calls instead of shares? Because options use leverage. You can control 100 shares with much less money. The downside is if you're wrong, the option can expire worthless. Let's talk about selling call options. Now we're the other side. Someone buys that call. Who sold it? Often, it's an investor who already owns 100 shares. This is called a covered call. They agree. If the stock reaches my strike price, I'm willing to sell. In exchange, they collect the cash today. Their goal is different. They don't want an explosive upside. They want income. The buyer wants movement, and the seller wants time to pass. Let's talk about buying put options. Put options increase in value when the stocks fall. They give you the right to sell shares at a fixed price. Investors buy puts for two reasons. Number one, speculation. They believe a stock will crash. Number two, protection. Imagine owning $100,000 worth of stock. A put works like insurance. If the market collapses, your put gains value. Now let's talk about selling put options. This one confused me for a long time. Selling a put means you're agreeing to buy a stock at a specific price. An example of this is Apple trades at 100. You sell a $90 put. Someone pays you money today. If Apple stays above 90, you keep the cash. And if Apple falls below 90, you must buy the stock. So why would anybody do this? Because remember, you have to buy 100 of them. And that means you would want to buy Apple anyway, and you basically got a discount. You simply got paid while waiting for a lower price. The buyer wants protection. The seller wants income. Not everybody necessarily trades. They might do more investing. I'm doing a mix of both. Some people buy companies simply to collect cash payments. These are dividends. And the goal here isn't buying or selling. The goal here is creating a monthly or quarterly income. Think of it like owning a small piece of a business that basically pays you rent. Now, let's start talking about day traders. Day traders rarely care about the company itself. They're looking for momentum, news, volume, price action. They might hold a position for 5 minutes or 5 hours. Their goal is simple: small gains repeated consistently. Now, let's look at the big picture here. The market exists because everyone has different goals. Long-term investors want growth, short sellers expect declines, option buyers want leverage, option sellers want income, and dividend investors, they want cash flow. Day traders want cash momentum now. Nobody's necessarily right or wrong with what they pick to do with their money. They're simply playing different games using the same marketplace. Understanding that really changed the way I looked at trading entirely, because once you understand what every player wants, you finally understand why the other side of your trade exists. So I hope everybody enjoyed this video and you learned a thing or two about trading. I know I have been deeply involved in trying to figure all of this out for myself. I took a whole bunch of trades once that rule was lifted and I got ahead of myself and I bought too many, and now I'm kind of sitting on them because they were longer term swing trades, I guess you would say, that I felt like I wanted to take. And right now I'm waiting on some of those. My day trades have kind of dwindled down. I'll do it here and there, but I tried to figure out how to utilize dividends a bit more for myself. So once again, I hope everybody learned something and you were able to understand a little bit more about the market and how each side moves in that said market. And you can go forth, especially if you are newer. If you've been trading for forever, this video probably won't do much for you, but if you are newer, I hope that you can go and get some ideas on how you will be investing and potentially trading your money. So until the next time, guys, happy trading.